Good morning. I'm Kirk Mitchie with Candor Advisors. Last week's post got a lot of attention, both on LinkedIn and even more so inquiries to our website and to me directly. And the issue is around essentially the difference between how much cash you as a business owner would get at the close of your transaction and whether there would be structure, which is what deal people call seller notes, rolled equity, earnouts. So to kind of build on that, I want to give kind of the group a little bit of a sense of what the most common issues are. And I'll do it kind of week by week over the next several weeks. So the first one is seller expectations around value. Now, your business is a little bit kind of your baby, and you may be too close to it to understand how the market values it. But it's important to kind of understand that something is worth what somebody will pay for it, not necessarily what you think it's worth. Now, you always have the opportunity as a seller, even if you engage an investment banker and go to market, to decide not to sell if the marketplace doesn't value your business the way you think it ought to. But seller expectations around value, most common problem in transactions. And so there are cures for kind of the mismatch. One of them, by structure, is to say, well, I as a buyer might think your business could be worth more money down the road, but I don't necessarily think it's worth that today. Because think of it this way, that a business is essentially worth what happened in the past, or valued based upon what happened in the past or what's happening, kind of the sales and the net income or EBITDA. There's a multiple of that a buyer is willing to pay. And then that number is either increased, there's a premium for what might happen in terms of growth in the future, or discounted for what might be vulnerable to that business continuing to be able to generate that revenue. And that's how the market values your business. So there is a way with structure to cure for that. Maybe you don't get as much cash up front, but maybe you get an earnout so that if you hit the targets that you think you'll hit, you get a lot more money down the road. There's some risks to that. You might miss those targets and only get to keep the cash you got up front. So you need to walk into that well advised. But that's one way to cure for it. Rolling equity in the business is another way to get more value down the road with a new financial partner who might be able to add capital, strategic guidance, operating expertise, relationships, and then the two of you participate at that second bite of the apple that gets talked about so often, or the second sale of the business. So there's a number of different structural solutions for a mismatch between your expectation of value as a seller and what the market might deliver in the way of buyers. If we can help with any of that, please navigate over to candor-advisors.com. Reach out. We'd love to chat with you. Either we or somebody in our network can help.